Welcome to Bulls, Bears, and Pigs podcast, presented by SizeTrade.com. Simplifying technicals, fundamentals, and market psychology for one goal and one goal only, to help you make money in all market conditions.
Good evening, Size Traders. This is Amos, your host, and I'm here today with Gary, head trader of SizeTrade. We're also here with an honored guest, Edward Offenbacher. He's the current senior advisor for international research relations at Bank of Israel and former director of the Monetary Finance Division. He's been at the Bank of Israel for 35 years and worked as an economist at the Federal Reserve Board from 1979 to 1982. Edward and Gary, thanks for being with us today.
Thanks, Amos.
Thanks, Amos. It's a pleasure to be here.
Edward, Gary has an opinion that eventually when the economy does come to an end, that the next bust is going to be a very painful one. Gary's been quoted that he expects a 60 to 70% drop in the markets. Do you see this happening? Do you agree with Gary?
Well, I think the first thing I have to say is that after the financial crisis of 2007 to 2009, one can't rule anything out. It's certainly a possibility, and the markets are extremely liquid and sloshing around there, and it's not clear what it's doing. And interest rates have been very low. Monetary policy has been ultra expansionary for a decade already. So you can't rule it out. Nevertheless, the feeling is that the odds of such let's call it a second mega crisis are probably not that great. And we've had prior to the great financial crisis. I always call it global financial crisis, but we want to emphasize the size here, so I call it the great financial crisis. Prior to that, there were many, ordinary crises. This was a mega crisis in 2007, 2009. Before that, there were lots of crises. And one of the questions is, what determines whether something is going to be a mega crisis? Mega crises don't happen very often. Probably the last one, of course, it's arguable. There's no formal definition, but I think it's reasonable to say that the recent episode had the potential to become another Great Depression. The previous crises over the past 30 years or so, Latin America, the savings and loan crisis and LTCM and all those, probably did not have the same potential to become crises. And of course, that's easy to say with 2020 hindsight. They didn't. And they were managed, the current one was managed too, but it just took a lot less money in the earlier episodes than it did in the current episode. My feeling, so why do I think that the odds of having such a disastrous Armageddon-like event again is not that great? I think probably, in spite of the fact that monetary policy has been extremely expansionary, the odds are that the private sector has been chastened by the episode in 10 years ago, and also the realization that the political will the political ability to bail out the entire financial sector, which is what happened. Okay? Basically, the entire world financial sector was more or less bankrupt, maybe more bankrupt, and the situation was saved with public funds, and probably the people in the private sector feel that the odds that can happen again, looking at personalities and who are leading the various economies, that's much smaller. So there's more fear ex ante among in the private sector, and probably there's somewhat more conservative behavior, less the kind of activity of countrywide savings and loan, or it was called California, the mortgage extensions and underwriting and stuff like that. In addition, probably the new regulatory environment is contributing something that's arguable. But my own feeling is that that mega crises don't happen so soon, one after the other. Again, that's the way I look at it. for all I can, for all I know, Gary may be 100% right, and we'll all be in major trouble. And then my view towards optimism that the fear is strong enough to prevent another mega crisis will be work in the wrong direction, because if that's wrong, then in fact the ammunition is there to have a very bad situation. So I certainly can't rule out the possibility that what Gary is saying will actually turn out.
Edward, let me ask you a question. One of the things that I've said in the past is that mega crises, I agree with you, mega crises don't happen often. I mean, you probably had one 1920s with the Great Depression, late 1920s, I should say, till World War II. And then after World War II, you had this Reconstruction period that lasted until the 70s in the US. And then the 70s, you had a crisis. I wouldn't say it was a Great Depression, but probably similar to what we had in '08. I wasn't around, but from what I've read, it seems similar to the one that we had '08. My concern is that we're not out of the crisis from '08. We haven't done, I get it, the balance sheets for the banks look totally different than they did in '07 or '08. But if you look at balance sheets from '06 and where bank stocks were trading, and you look at the balance sheets today of the banks, they don't look too dissimilar. There was some regulation put in to take away some risky behavior, but overall, you see the lending is there. It's just not lending into the mortgage; it's lending to the corporate departments. Corporate debt is at extremely high right now. Most of that is being used for buybacks. So I think when we're gonna, in my opinion, when we're gonna look back at this decade or 15 years, we're gonna say, oh, okay, well, it started in '08. They tried to manage it. They failed, not because necessarily they were bad at it, just we're in a bad situation. And then the real crisis happened, let's say 2019, whenever it's going to happen, I don't know. And then when they look back at it, it'll be one episode. So like the Great Depression, if you look, the crash happened in '29, and then you had a rebound, and then I think it fell back down at 36 or 37, and then you had some type of rebound, and then 39 was bad because of what was going on in Europe. I think that's a potential where we're going to see it as a whole, as opposed to now while we're living in it, we see it as, oh, well, that was the last recession. We have a new recession coming. One of the questions I wanted to ask you, and the thing that I stress a lot, is that low interest rates for such a long time is very bad. And that the reason why is because it takes risk out of the system, right? It becomes very riskless to take a bet because you're borrowing money at such low rates. How do you see them being able to raise rates going forward when corporations and governments have so much debt on their balance sheets, and at some point will have to refinance that debt?
Yeah, I think that's an important consideration. Let me start with the renormalization process. I think first of all, I agree completely that interest rates have been held too low for too long, given the situation of the economy, the things that one usually looks at, say in the Taylor rule, the growth rate of real output relative to potential, and inflation relative to the target of 2%. So now with nominal GDP growing about 4%, and unemployment also about 4%. The economy in the States, at least, is very strong. The situation in Europe, I think, by the way, is different. There, the situation of the banks is not as good. But certainly in America, it seems a little odd to me that interest rates have been kept as low as they've been kept, with the main parameters warranting a higher interest rate than under most normal circumstances. Now, I'm personally, being in Israel, I'm not familiar with I haven't done calculations about the effect of renormalization on debt service payments and whether the corporations can manage it. But I'm sure the Fed is doing that, and that's probably an important consideration beyond the usual Taylor rule considerations in the speed of what's called what we used to call in the 70s the reentry speed, where then the reentry speed was bringing down interest rates rather than bringing up interest rates. But the other point I wanted to make, Gary, based on what you said in your the beginning of your comment, is that I presume that when you raise interest rates, there are going to be some, significant number of enterprises that are going to be in difficulty, and some won't be able to make the payments, and it'll be a problem. I think there's a big difference between that and a mega crisis. And yes, what can you do? The size matters. And if after the recovery that's been taking place now for almost a decade, runs its course, there's going to be some downturn, and the question is whether that's going to become another mega crisis. What is it about the situation that will make it a mega crisis, or let's say an ordinary crisis or an ordinary recession? Now, my answer to that for the crisis of 2007, 2008 is the answer that was given basically by Rajan, the University of Chicago finance professor who became governor of the Bank of India, or the Reserve Bank of India. And he was saying that there was too much finance and too much complicated finance, that basically nobody knew what his counterparty situation. They said during the crisis, it wasn't enough to know what your counterparty was. You had to know what your counterparty's situation was, and maybe even more further down the line. So there was such an asymmetry of information going on due to the toxicity of some of the deals that were being made. I think that was an important contribution, not to the fact that there was a crisis, because the housing situation was enough to make it a big crisis, but to make it a mega crisis. What could that the overfinance is what converted what would have been an ordinary crisis. An ordinary crisis is no joke. Okay? So the overfinance converted that into the mega crisis, where again the entire financial system failed.
Right.
Now,
No, that makes sense.
What's the pipeline now that's going to do that? Just a lot of, somewhat. I don't know, it's hard exactly to say exactly with the right adjectives how much credit, how big of a excess credit extension. I don't want to say the B word. How much excess credit extension is necessary to tip the scale in terms of making the situation as bad as you think it is. Nobody, of course, knows. But my gut feeling is that hasn't quite happened.
Well, let me throw a curveball out there. One of the things that I've thought about, because I obviously think about this, I don't know the future, so I think of different scenarios. One of the things that I've been thinking about, what is the black swan? Everybody talks about this black swan because we don't necessarily know what it is. But the question I have is, isn't every recession, if the Federal Reserve didn't act, so if you go preview to 19, I believe, 30, before the Federal Reserve was created, you had a lot of crises, right? And that's one of the main reasons why they created the Federal Reserve, is because they thought by controlling interest rates on both the way up and the ways down, you could control bubbles from being formed, and you could also stop crises. And I think it's a really good idea, and I'm pretty sure it was done after the Great Depression. And so one of the things that I have is that the Federal Reserve needs the ammunition to protect any recession from becoming a mega crisis, because I have this idea that recessions and growth are both like an avalanche, so that once it starts going down the hill, it's almost impossible to stop. You need to really have a forceful ammunition, if you want to call it, to stop it. In the case of the Federal Reserve, they could lower interest rates. In 2008, they had to go into quantitative easing. And my feeling is, and one of the things that I'm thinking of, is that it could just be potentially that we have a recession and there's no way of stopping it. because we all know, once you start let's say people stop buying cars. People stop buying cars. Now GM downsizes. Those people lose jobs. Unemployment goes up. Those people can't buy cars. So it's kind of avalanche. So you need some type of way to be able to, a safety net, let's say, to protect us from a crisis. And usually it's either fiscal response where the government spends, but I don't know if we have the ability to do that or the stomach to do that, because we're at over 20 trillion in the U.S. Countries all over the world are at least 100% GDP. You have Japan, who's 300% of GDP. China, if you take their local governments, as people say, between 200 and 300% of debt to GDP. The U.S. is around 120%. Italy, Greece, all these countries. Germany's doing fine, but even France, they have really high debt to GDP ratios. So I don't know what the response could be fiscally. And when you look at interest rates that are near zero or at zero in the case of ECB and Europe and Bank of Japan, or negative in Bank of Japan's, where's that ammunition going to come to stop it? Are they just going to continue to buy a paper, 10-year paper or 20-year paper? But the problem is we've seen that has hit a wall, because once the 10-year or longer rate paper goes negative, that doesn't work anymore, right? Because you're now punishing the banks. The banks can't pass it along. Mortgage rates actually spike because the banks need to make up for some type of for the 9-10 basis points they're losing. So now we understand that we can bring rates only down to zero. That negative interest rates doesn't work. I mean, that's why the Bank of Japan put a 10 basis point floor for the 10-year. So the question is once you reach that level and you have an ordinary recession, how do you stop it if you can't get a proper response from the government because way too much debt already out there? And you can't get a response from the central bankers because rates are so low. Can an ordinary recession turn into a mega crisis? That's my question.
Yeah, the answer, my feeling is an ordinary recession could potentially turn into a mega crisis. And there are models where that can happen. There's a well-known paper by Allen and Gale in 2000 called Financial Contagion in Journal of Political Economy. Potentially, all these scenarios are all seem to be feasible. They're not so outlandish that anyone, I think, in his right mind could call it crazy. I think it's certainly a possibility, and that was the first thing I said in right after the introduction, that I certainly cannot rule out the kind of doomsday scenario you're talking about. Nevertheless, I think the empirical evidence is that, I mean, there have been many recessions in post-war period, and certainly before that. Maybe the regimes were different. I don't want to talk about it. And perhaps more importantly for this particular conversation, I'm far from being an expert in the pre-war history, so I certainly don't want to talk about it. But I think if you look at the post-war history, most of the ordinary recessions where people slow down buying cars, not everybody, by the way. And even in the Great Depression, not everybody was standing on bread lines or trying to sell apples in the street. Right. So again, it's a monetary policy, and it's in the end of the day, it's a quantitative issue. It's how much and what's the size, and the recessions that have been brought about by monetary tightening, which was not the build up to the global, well, to some extent it was in the global financial crisis, but I think again the key ingredients in converting it to a mega crisis were not the monetary ingredients. But if you look at the previous monetary recessions, and there's lots of formal research on this, is that they're recessions, and in some cases, you can have, hairy situations like LTCM. But in the end, I mean, LTCM was dealt with without the government spending a penny. The New York Fed was able to organize, probably with some, messages there, a consortium of banks to deal with the problem. So my feeling is that feeling, maybe it's a hope or a prayer, but again, my guess, again, this is not supportive of any research. Nobody can do research that ices the future. But my feeling, based on experience, is that to have such a difficult situation as the global financial crisis so soon after the previous one, when the trigger for the change in the cycle, it will be a typical monetary tightening. Those are usually ordinary recessions.
Right. Well, I want to say something that you said that the 2007, 8, 9 Great Recession, let's call it, was not brought on by monetary tightening, I should say. See, in my opinion,
Right.
I'm sorry.
That was spoke too soon, too fast.
Okay. Yeah. My thing. Yeah. My thing is this, that this is the way that I look at it. And tell me where I'm looking at it incorrectly. I'm looking at it going back to the 70s. You had an inflationary spike in the 1970s. Some of it had to do with oil. Some of it didn't have to do with oil. Volcker, who was the federal president at that time, raises interest rates all the way up to, I believe it was 20% or near there. Unemployment obviously spikes. The economy can't grow fast enough at those interest rates. Nobody's borrowing money. But he cuts out the cancer. At that time, it was inflation. Now, once that happened, I believe 82 or 83, you start lowering the interest rates, and all of a sudden you have this jolt coming into this market. So the economy is almost like a spring being tightly held. And then once you start releasing interest rates and lowering it, all of a sudden that spring explodes, and we had great growth, amazing growth. Yeah, we had some bubbles, saving and loans, but all of these bubbles, which I would call mini bubbles at the time, were dealt with by then Federal Reserve President Greenspan, because he took over, with cutting interest rates. And when you mentioned long-term capital, he did the same thing again. It was, I believe, 1998 or so, and the economy was growing gangbangers. I mean, the Dow was at near 10,000 from 1,000 20 years earlier. Everything was spectacular. Unemployment was full potential, or employment was at full potential. Everything was going spectacular. He lowers interest rates, and obviously he stems the problem. But all of the savings and loans and long-term capital, he never solves the problem of the underlying issue of too much leverage. And then in 2000, finally, because interest rates went just high enough to pop the tech bubble, and in my opinion, if he would have taken longer to pop the tech bubble, it would have been just more catastrophic. Greenspan responds by cutting rates again to historic low rates at this point. Post September 9/11 was, I think, 1%, which is the lowest rates were ever in the United States at that point. And what that does is it builds another bubble, and it builds a bubble in housing because rates are low. People are now afraid to invest in stock market because they just went through that. They pump all this money into the housing market, then eventually flows back into the stock market because the economy does good. So now you have almost like these. You've never solved this problem of too much leverage in the system and rates too low. And then Bernanke, in my opinion, took too long to raise rates. He did raise rates, but he was too measured, in my opinion. And the longer you keep rates low, and this is the environment we have now, the longer you keep rates low, the harder it is, or the lower the threshold the economy can accept of higher interest rates. So even though, for historical sake, if you look back in 2007, I think we raised interest rates to 4.5% to 5% for the Fed funds. It was high enough because people were so used to getting rates at 2-3% for housing or whatever, that was high enough to cause a bubble and pop the bubble. And now you're here again and again. I don't know how we solve the problem of leverage. How did we solve this problem? If it's kind of like if a patient has cancer, giving him more cancer is not going to save it. And that's what I felt like we did in 2008. And I think it was the right move in 2008. Bernanke did the right move in 2008, 2009. He put his foot down and said, we're going to stop this crisis, even if it's extraordinary. But now you're 9-10 years in, you still basically have in Japan and in Europe, you have emergency measures in place. You have historically low rates still in the United States. I think we're at 50 basis points now on the Fed funds. And it's just crazy to me that leverage you have to drain the system of the leverage, kind of like what Volcker did. And Volcker did it for inflationary purposes in the late 70s, early 80s. But we need to take this leverage out of the system. And I just don't understand, like, that money has to go someplace, right? And when interest rates go higher, this economy that's growing at 2% or 3% worldwide, or whatever the number is, growing, once the interest rates go up and you take that leverage out of the system, the first thing is that the economy, the GDP, worldwide GDP, is going to come to a stop, right? Because it's so used to having this amount of leverage coming into it. And then once that happens, you're going to start seeing bubbles pop because corporations won't be able to make enough money to pay interest. Governments are not going to make enough money because debt to GDP is at 120% or 150 or 200%. But then if you lower the GDP side, that goes through the roof. And what is the response? Because the response for the last 30 years has been spend more, cut interest rates, spend more, cut interest rates. And if this happens at 1.5% on the Fed funds and 20 trillion or 20 plus trillion of debt in the United States, are we just, I mean, does debt not matter? I mean, what's his name? Krugman says debt just doesn't matter. Can we just go to $80 trillion worth of debt? Can Donald Trump or whoever president will be at the time, can he just increase spending by 60 trillion and there's no side effects to that? Where am I seeing it wrong? Am I just wrong? Can we just take out as much debt as we want and that's it?
I don't think you're wrong. I just think that there's another scenario. Distributions have both sides. They have the minus side and the plus side of the meeting. So again, I certainly wouldn't rule out that possibility. Again, we saw something like this not too long ago. I mean, 10 years isn't a little bit of time, but it's certainly not that long ago. Someone who was involved in many meetings in a country that wasn't really hit that badly, but making all kinds of contingency plans. What if? Those are still fresh in the memory, as long as my memory still works. But there's the alternative. Now, the other scenario. Let me start now with the late 90s. Again, it's true that things went on for too long, but in the years 97 and 98 and 99, there was a real significant tech boom, and in fact, Greenspan. I'm recalling vaguely from a description in the book by Bob Woodward called Maestro, which described, but it's basically a biography of Greenspan and focusing on his years as the chairman of the Fed. He was at the forefront of with the researchers in identifying the fact that at that point in time, the innovative part, there's a distinction between invention and innovation. Invention is when you invent the capacity to do something, and innovation is when it's brought online and it actually has effects on economic activity. So, and there could be a big gap in the timing between the invention and the innovation, mainly because the economic profitability of bringing a given invention into use might not be there when it's invented. A classic example that I did research on myself at the board was what was financial management. The computing capacity and programming capacity to do modern financial management already existed in the 1960s, but then interest rates were sufficiently low that it didn't pay to spend a lot of money to do this. But then when the interest rates rose in the mid 70s, prior to Volcker, and as inflation picked up, then firms began to invest heavily in financial management, and there was a big technological improvement. So throughout that was the 70s. In the 90s as well, the the innovative aspects of the personal computer, which had been invented in the early 80s and then developed in the early 80s, developed before the early 80s, began coming online in the early 80s, but still it began to hit the business sector in a bigger way later on. So that generated a big growth of what the macroeconomists call a positive supply shock, where the combination of growth, high growth and low inflation, was not predicted by the Fed's macroeconometric models at the time. So that was a situation where there was justification to a point for financial expansion. But of course, as we know, as with 2020 hindsight, it went too far, and we got the dot-com crash. And again, but most bubbles that we wind up having, which we decide ex post are bubbles because they burst, have a fundamental element that generated them in the first place. And the question really is not so much whether you're going to have that kind of qualitative development. I agree 100% that it's reasonable to expect that. The question is, how bad is it going to be? Is it going to be another total disaster, or will there be some combination of financial, in spite of the growth of the financial assets, for the financial conservatism, or in terms of the types of contracts, in terms of the deals, in terms of the asymmetric and lack of asymmetric information, some better regulation, some economic growth that gets the ratios looking better than if there wouldn't be economic growth. A combination of those factors that will generate a normal recession rather than a great recession.
Okay, that makes sense. I mean, I hope you're right. I don't want.
There's more prayer than a prediction,
right? Right, exactly. No, I hope you're right. I mean, I want to say I hope we never have recessions, but I understand that's bad as well. So, I hope we have an ordinary one. I've lived through some in like the early 90s. I believe we had a recession that wasn't so bad. But as an adult, I never had a recession that wasn't. Even 2000, we don't look back at it as a crisis, but NASDAQ fell. I don't remember what the exact, but 70% or 80%. It fell. It was pretty. It decimated the NASDAQ pretty hard. But I definitely hope you're right on this. I had another question, since you've been on, Israeli central bank and also the Federal Reserve. Do you think that there's too many economists on these versus practical people who either, let's take a banker like Jamie Dimon. I really admire him. Do you think that they should do a better job of bringing in people with some corporate experience and who understand markets? Since markets really, at the end of the day, the markets and the housing market and treasury markets, the stock market really drives the economy a lot of times. Do you think they should bring more of these type of people on? Because it seems to me like, especially the U.S. Fed is all lifetime economists who never really participated in the private sector. They only participate in the private sector after they leave the Fed.
Okay, well, I don't have. First of all, I think that's not quite correct. The Fed, there is a tradition. I don't think it's a rule. I think it's a tradition of having some members of the Fed who are, say, consumer advocates. I'm about to say that in terms of business experience, I agree with you that at least in terms of my quick recollection here, maybe my memory is not quite as good as it was about the late 1990s. But thinking about members of I don't know about the presidents of the Federal Reserve banks, who will play an important role in the FOMC, of course, but right. There are private sector people, but not so many bankers, I don't think, if I'm not mistaken. It could. And the other thing I'd like to say in this regard, that among the economists, there was an amazing degree of groupthink before the global financial crisis. I mean, all the thinking that went into the formulating the monetary framework during the Great Moderation. There was nobody, there were no contrarians in the language of the Babylonian Talmud. It's ipcha mistabra. It's somebody. There are, in the Israeli army, there's a function that there's a special unit in the planning units and in who's tasked with preparing opposite scenarios to the mainstream scenarios that are presented by the senior commanders. I've recommended the Bank of Israel we set up a unit like that, but of course you never have enough people to do it. So within the economics profession, there was quite an unbelievable amount of groupthink before the financial crisis. And Rajan, for example, was and Schiller and the few economists who did predict the crisis were really far and few between, and were not taken seriously. But the idea of bringing in some business people, sounds. I can't think of any problem. There might be conflict of interest problems. It might be that it's too hard to get people to do national service in a sense. I mean, these are people who
right.
The earnings differential is quite significant. So I'm not sure exactly why Federal Reserve Board or so maybe some other central banks have not had more people with street experience, but certainly something worth thinking about.
Right. The other thing is a lot of times when economists see a problem, like in '07, there weren't so many. A lot of times their solution is cut interest rates, right? So we see that with Krugman, who's for expansion and keeping rates lower for longer. He's saying that, if you raise rates, you're going to have a recession. So the solution to that is keep rates low. And to me, that's a little lazy because obviously you're going to be right in the near term. If you keep rates lower, you're probably not going to have a recession. The question is the severity when you eventually do have it. So I would like to, I don't know what Schiller and Rajan said. I wonder, did they have any good, do you know off the top of your head? If not, I'll read about it. Did they have any decent solutions other than, well, maybe we should have raised rates?
No. Do the Krugmans have some decent solutions? Not that I know. I mean, they're basically traditional Keynesians. I mean, Krugman is a brilliant academic economist. I mean,
right.
I read his column fairly frequently, and very often I find it very difficult to argue with him, even though I just love to argue with him more than I could. But I mean, I'm with you in feeling that basically, just to keep interest rates low and throw money at the problems is not the right approach. Now, one maybe no less brilliant, not with a Nobel Prize, economist who was in government for many years, many positions, was Herbert Stein, former chairman of the Council of Economic Advisors under Nixon, and he had a great statement. He said, "If something is not sustainable, it will stop." Huh. So I think that's a great pearl of wisdom, and I agree that again the point I'm harping on is what's going to be the nature of the stop. Is it going to be a really hard landing, or is it going to be a bearable? It's not going to be soft, okay, but is it going to be hard, or is it going to be less hard?
Right. I understand that. No, that makes sense. I do. I guess one last question from me. I don't want to take up too much of your time. I could sit here and talk all day, and that's probably not a good thing. I've made a comment in the past where I think, well, we all know textbooks tell us that when you lower interest rates, inflation goes up, partly because you weaken your currency, partly because you encourage animal spirits to, people hire, wages go up and so on. But keeping rates so low for so long, in my opinion, was detriment to the inflation. And I think one of the reasons why we have this deflation around the world is because interest rates are low. And actually, you know, what you've seen in America is that as Yellen raised interest rates, be it a quarter of a basis point, 25 basis points, I apologize, or 50 basis points. Now, all of a sudden, you're starting to see inflation pick up, and you would think it would be the opposite, right? Because if you're already in a deflationary situation, if you raise interest rates and you strengthen the currency, I mean, dollar is over 100 versus a basket of currencies now, you should see deflation, and you've seen inflation. So, do you disagree with my point that low interest rates for so long causes deflation? And you know, obviously you haven't read some of the stuff, but basically my whole point is that when you have a Japanese, let's take car makers, Toyota, selling cars in America, and their currency, because they're keeping rates really low, artificially low, their currency is weaker versus the dollar, then they don't have to increase the price in dollar terms of their car, because when they convert it back to yen, it automatically goes up. So it's an incentive in their position to keep the price of the car in line to try to steal market share from General Motors or another car maker. And since the world is growing so slow, there's not an expansion of market share. So they're all fighting over the same market share. So GM now is forced to keep the price of their car low, and they look to make earnings growth other places, which I've been saying is through buybacks. You know, we've historically never seen any type of buybacks like this ever, where they borrow cheap money and then buy back stock. So when you buy back stock, you decrease the amount of shares that are available and thus increase your earnings per share. So basically, they've all fought for market share by keeping prices low or stable, I should say, not low, but stable, and figure out different ways to make money. For the Japanese, it's converting it back to a weak yen. For the US, it's buying back shares and decreasing the amount of shares that when you divide it, you know, the earnings divided by shares, you decrease the shares, you keep the earnings the same. All of a sudden, your earnings per share went up. So I've been making this point for, 5 years. I've never actually made this point to an economist. Actually, I have, and she didn't really listen to it through. I just wanted to get your opinion on it.
Well, you bit off a lot for me to chew here. Let me start at least with the relationship between interest rates and inflation. And here I'm going to harp back to, but here my gut feeling is that ultimately, or I don't have any new way of thinking about it. I mean, I think the economics profession has been surprised to some extent about why inflation has stayed so low with such expansionary monetary policy. But there are quite a few questions. The question of why investment hasn't picked up. But I think the conventional wisdom, which I still think is valuable and will prove pretty much valid, is that the negative relation between interest rates and inflation is over the short run. And now this short run has been pretty long in the current episode. But the notion that you lower interest rates and you stimulate the economy and that generates some inflation, that takes place in what we call the short run, which say Milton Friedman at the time estimated about 1.5, 2 years, that kind of that order of magnitude. And maybe it's because of globalization or whatever reasons, the dynamics are much longer. They take much longer. But in the longer run, using the same causal structure, and in a minute I'll get to a new old development on this. So the causal structure is that demand eventually gets excessive and inflation picks up, and then they raise interest rates. So there's a correlation between, in the longer run, a positive correlation, not a negative correlation in the longer run, between interest rates because of the inflation compensation or expected inflation compensation. Not talking about tips here, we're talking about nominal bonds. So over periods of 4, 5, 7 years, as estimated by Friedman in his 50s and 60s, you get a positive relation between inflation and interest rates. And that's basically still pretty much the conventional wisdom. There's now a new literature called the neo-Fisherian approach, which says that low interest rates cause low inflation. Okay, in the long run. I don't understand it well enough to expand upon it in this podcast. I'm afraid. I've read some. I began to read some of the papers. I mean, this is an old an old argument, or it's neo-Fisherian after Irving Fisher, who was perhaps one of the greatest American economists in the first half of the 20th century. One of certainly up there among the opening five. But there've been a number of papers over the past couple of years arguing that the traditional Keynesian type model approach to, and Friedman here is like Keynesian towards inflation is not the correct way of looking at things, and the causal structure is different. But so that's one point in terms of inflation interest rates. In terms of the currency issue with the yen weakening and therefore Toyota can sell cars, that's the issue of currency wars. There are currency wars going on, affecting many economies. This is in my view, is a prisoner's dilemma situation. Lose.
Right.
And that's the way it's being played, and it's a dominant strategy for each individual player. That's why it's a dilemma, prisoner's dilemma. So here there's a well-known paper by the economist John Taylor at Stanford University that if all countries follow his Taylor rule and do by his definition conventional policy, then you don't need coordination because everybody's targeting the same 2% inflation target, et cetera. But they're not doing that. Everybody's trying to beg at a neighbor and
right.
That sort of problem. In terms of buybacks, a buyback is it seems to me just another investment. Again, you could invest in your company and you could invest in other companies. Again, I'm not an expert, and I have to, but at least in terms of the straightforward economics of it, if you can borrow cheap money and think you're going to make a profit, then you may as well do it, whether it's buying your stock or somebody else's stocks. Of course, you may know more about your company. You may know that the stock is worthwhile, and then you'll be able to pay back the loan. And if you're wrong, and if you're banks, then you're in trouble. But it seems to me that there's sort of like a separation there between what the companies are doing on the financial side and what they're doing on the business side in this particular issue.
Right. Well, the buybacks, I've been on record as early as 2011 saying that you should buy stocks that as a trader, you should buy stocks that do buybacks. It has nothing to do with that being an efficient place to put your money. I think it's destroying the future growth rate of the company. But again, as traders, you can't short a stock, hold it, for it to double or triple against you, and then eventually you're right. You're better off playing the trend and then catching the downside when eventually that does happen. Buybacks, the way that the capitalistic markets have always worked is you borrow money because interest rates are low, or you think you can make more money investing it someplace than what the interest rate is giving you. The problem that it seems to be is that with interest rates so low and so many margins being squeezed because money is flowing so easily, is that basically it's just better to buy back your stock, see an appreciation of your stock price, because the CEO at the end of the day gets judged by the stock price. So he cares about the short term.
It's short-termism. That's the problem.
Right.
I mean,
right.
I think the fundamental question from an economist's point of view is why are the investment prospects so poor? The real investment. Why is building a laundromat or a shop, or investing in R&D or or investing in the real side of the business, why are the prospects seem so bad that you're willing to prefer this or that financial investment? And the contradiction in terms of buybacks is that if your company seems to insist to doing so well that you're willing to borrow money to buy the stock, then why aren't you investing in the company?
Right. Well, that's the thing, is that
That's a puzzle.
Well, the CEO, look, so you have two scenarios. You have a scenario where CEO doesn't care about the company, wants to make a lot of money. So he's judged by the stock price by his shareholders, who he's beholden to. Now you have a CEO who started a company, who loves the company. All of a sudden you decide not to burn your balance sheet and say, listen, I would rather have the ability to burn my balance sheet when times are rough, like we've always done in the past. So we keep our balance sheet clean. We earn 6%, 5%, whatever it is, organically by running a successful company. And then when the economy does turn and we need to be able to go and get those lines of credits, that's when we're going to use it, and we're going to withstand versus the company that borrows a lot today and doesn't have that capability. So when he says that, activist investors, Carl Icahn, Bill Ackman, some of the two big ones, come into the company. They buy a big share of the company because, again, money is free, so it's easy for them to get really high leverage. So what they do is they buy 10% of the company. They even did it with Apple, which is Icahn did it with Apple. He was only able to buy 3 or 4%, but he was able to buy enough to make Tim Cook buy back shares of Apple. So what they do is they go to the CEO and say, listen, if you're not going to do it, we're going to do a proxy war. We're going to put our board members on, because guess what? Every single person who owns stock except for you wants the stock price to go up. So what I'm going to do at the next annual shareholder meeting is I'm going to go up there and say, hey, if you vote in my guys, I'm going to push for a buyback, because we have a clean balance sheet and you could go out and borrow money at 1%, buy back a ton of stock. When you buy back the stock, you do two things. First is stock market is demand and supply. So if you're doing a big, massive buyback, you're obviously increasing the demand while the supply stays the same. So the price will go up because of that. But also it'll go up because stocks are priced on EPS at the end of the day and PE ratios. So by buying back shares, you're decreasing the division of shares. So your EPS goes up. So this company that's growing organically 5-6%, which is healthy in this environment, all of a sudden you either blackmail the CEO that we're going to kick you out unless you do it, or he just agrees with you because he doesn't want a war and which he knows he's going to lose. And all of a sudden the stock starts growing at 12 or 13% year over year, not because they've done anything else in the business, just because they've bought back shares. So that's very dangerous in my mind. And
I agree. It's short-termism, and as I said, and I'll quote Herb Stein again: if something is not sustainable, it will stop. And
right.
And I could quote Chuck Prince. If the music is playing, you got to dance. So those are dangerous situations. And again, basically, if that's the game, then I agree with you. That's a problem.
Well, it has been, and it continues to be. Buybacks are all-time highs. Gonna just finish it on one last statement. Do you think that the economy can withstand a 70% drop in the stock markets while not going into a very deep crisis-like recession? Do you think that are they so connected that if you see a 70% drop in the markets, because in my opinion the markets are way overpriced because of buybacks, right? So they're artificially overpriced. So maybe I'm wrong. Maybe we can see a 60-70% drop in stocks, which would, in my opinion, bring it back to sustainable levels for now, and the economy can withstand that. Or do you think that the wealth effect that Greenspan pushed so much is still in play, and that a 70% drop would, no matter what, cause a crisis in the overall economy?
70% is a lot. I think that would be. I don't. In my days at the board, I used to know what the coefficient of the stock market and the consumption function was, but and it is, it's there. So certainly that would be a problem. That would be also a big problem for the elderly, for the senior citizens, because they, having just taken a big hit with low interest rates, it also take a hit on their stock portfolio. So certainly that magnitude would be quite bad. On the other, on the every cloud having a silver lining. Here, I'd say that it's not balanced. I mean, 60-70% is bad, but
Right.
the slightly optimistic lining to this cloud is that stock crashes have had less real effects than real estate crashes. I mean, real estate is so widely held that when real estate crashes, it affects really almost many households, whereas stock crashes historically have been more contained. On the other hand, the more you have pension funds, the more widespread it is. So,
Right.
70% would be not good.
Well, thank you so much for your time. We'd love to have you back. There was a lot of knowledge, and I'll have some more questions for you, I'm sure, in the future. Thank you so much for your time.
It's been a pleasure doing this, and I appreciate your sentiments, but it's like I'm sure like you do, I hope they're wrong.
Yes, I hope I'm 100% wrong.
Gary and
I would
Edward,
love.
thank you very, very much for your time. We'll stay tuned, and as always, Size Traders, subscribe. We'll keep you updated. Till next time, this is Amos at SizeTrade.com. Gary and Edward, thank you so much again.
Bye.